Welcome to our year-end tax planning for property owners. We have with us today CPA Dan Marsh. He's going to go through some ways to help you save on your taxes, and then we're going to open it up for Q&A at the end. So as you go through here, feel free to type in your questions. Jay's going to monitor the Q&A for us, and we'll probably take a few questions along the way and then just kind of open it up at the end. So to kick things off, Jay and I are the principals at West Peak Properties. Our mission is to help you create cash flow and build wealth through investing in real estate. We are a full-service brokerage company specializing in small investment properties. Anything from, say, a 2-unit up to a 12-unit property is generally within our wheelhouse. If it gets a little bigger, we've done those too. If it gets a little smaller, we've done those as well. Maybe you want to invest in a single family, something with an ADU, or even a condo, something like that. We can handle that as well. We help you buy it, sell it, manage it, 1031 exchange it. We've even got contractors if you're looking to fix something up or need to make some repairs, etc. We can always refer people out to you as well. We've been doing this for about 14 years now. Lots of combined experience, hundreds of transactions closed. We own our own properties as well, so we have a lot of experience with what to do when you're dealing with challenging tenants, things like that. Always feel free to ask us about any questions that you might have relative to your investment properties, strategies, things like that. We do have, having done this for a long time, we've built an extensive network of investors, and we do have an email list, which most of you are probably on if you're on this webinar right now, but about 20% of our transactions every year occur off market. So if you have something to sell or you're looking to buy, always a good idea to reach out to us and see if we've got anything for you or if we can help you get that property sold as well. We don't do property management ourselves. However, we do work with experienced property management companies that we can refer you to. And so if you have a need for property management, feel free to reach out. This is how you get a hold of us. I'm Brad Uhlig, Jay Peterson. Emails are here, phone numbers are here. And again, reach out with any questions that you have. So today we've got, we want to thank Dan for joining us. He's a very popular speaker. He's been one of our most popular. We've had him on these webinars 2 or 3 times now. And people love to ask their questions of Dan. Tax laws change every year, and there's always ways that you can manipulate things sometimes to save money on your taxes before the year end. So we typically like to have this every year around this time. And so I'm going to turn it over now to Dan and let him kind of introduce himself, give us a little background on himself, and then head into our presentation here with the topics for today.
All right. Can you see the slides?
Yep.
There you go. Nice. All right. So obviously you've got my name. It's Dan Marsh. I've done this a few times with Brad and Jay, and I've been a CPA for the last 23 years. And most of that I've spent a lot of time in doing real estate and private equity real estate. So, and we also do, your average mom and pop type businesses as well. So the good news is I can tell you for the current year is because of the way the federal government works, we're in a bit of gridlock. And that means there's not a lot of changes that have come down the pipe. There's a few, but not a lot. Normally you need both House and Senate to be able to get some rules passed or some changes done. But I don't mind the gridlock. We don't get tons and tons of changes in tax law. But they're always there. There's a playbook that people, or excuse me, one political party over the other wants to push out. So, our big fear is always those changes and hopefully getting people prepared for them, or that they know that they're there. I always liken it to who's the referee on the field and how do you play your game around that referee, right? Rather than get caught up in the referee. So let's dive into it. I put some topics together that just some of the stuff that I saw kind of come up this year from people or clients that had these kind of issues. And I put a couple of topics together that I think are the most popular, going from most popular down to the least. And really, the first one I thought of was we did a lot of. It's called the pass-through entity election. I'll kind of dive into that, and some backdoor IRA tax planning, some of the things you can do with your IRAs. And then also we had a bunch of these this year, and it's really from elderly parents or elderly clients that want to give their property or make sure it's passed to the next generation as they get older. And I'm going to go through that because I had a couple of them, and some of them were really not the way you wanted to do it, and we ended up. I'll go through that example. It was basically ended up going through court to get it fixed, and then what we call some tax loss harvesting. And what can you do if you got some losses, you've got some income, and how do you kind of fix or get ready for the end of the year and building a really good, a tax result, basically just looking at your portfolio, including your real estate. So the first one, let's dive into it. The pass-through entity tax election for Colorado. They call it the
Dan, did you flip your slides? Because I'm still on your first slide.
Yeah. I'll dive into what's called the PTE election. So anybody who's ever seen this, Colorado passed what a lot of states have passed, and it's driven from the fact that in 2018, when Donald Trump was president, they reduced, let me say it again, they reduced the Schedule A itemized deduction, which is on your personal return, Schedule A itemized deduction for state taxes that you paid, right? In essence, they said you're limited to $10,000 in itemized deductions for state taxes. And so, as you can imagine, most of the states that had big income tax, California, New York, New Jersey, Minnesota, were kind of up in arms about it because it limited, they have double-digit tax rates. It limited their ability for their citizens to be able to deduct the state taxes paid on their federal return. So there's a workaround. Of course, the states started figuring out how to fix this or work around it.
Hey, Dan, do you have a slide on this?
Yes, I've got it up. Is the Colorado pass-through PTE? Can you see that?
I'm not seeing. Jay, which slide are you seeing?
Still seeing the first slide?
Yeah.
Let me see if it's stuck. You are screen sharing. It should be the Colorado pass-through election, but I don't know why it's not showing the.
Still seeing your opening slide. I just want to make sure we have the visual with the words here.
I've got it saying screen share, but it looks like it's.
You still got to move your slide. You got to flip your own slide. I don't have.
No, I'm flipping the slide. I don't. Maybe if I stop share and reshare, maybe it'll jump over to it. Let me stop it and then reshare it. Maybe it'll jump over. Hold on. It must have froze. So I apologize. I'm getting to the age I was telling Jay.
There you go. There you go. All right.
So I'm getting to be an old fossil. So technology is getting ahead of me. Right. So anyway, pass-through entity election, what it really is, it's a way to beat that $10,000 limitation. And Colorado's passed this law, and the feds have said yes, it works. Basically, if you own an entity, an S corp or a partnership, you can pay the tax, the state tax through that S corp or through that partnership. The advantage to that is the federal government has allowed you to deduct the dollars on that federal pass-through. So to say that again is I can expense or pay the state taxes at the entity level, the pass-through entity, the S corp or the partnership, and then deduct it on that entity tax return. The benefit to the individual is, let's say you're the sole owner of that S corp or the sole owner of that one of two owners of a partnership. Those dollars now get deducted rather than that you lose them or limited out at the $10,000 limit. Okay, so it worked its way around Schedule A, that $10,000 limitation. So best things to do really for you is really review your entity. If you have an S corp or a partnership, make sure that if you do owe some tax and some state tax, look at your personal return to see if you've limited to that $10,000 Schedule A itemized deduction on your personal return is limited. Make sure that you make this election and pay the taxes at that entity level. And the other real thing to really look at for 2023 is if you've been contemplating doing an entity, right? I get calls all the time. Should I be an S corp? Should I be a partnership? I don't know. This might be the year to do it, but make sure it has a benefit to you, right? Is this PTE election, is a benefit, but it, it's not if you don't hit that $10,000 limit on that Schedule A. So make sure you look at that because it is a nice benefit for people, and that goes through for about another 30 states as well. So even not just Colorado, it's all over the U.S. that this is occurring. There's some states that do this, but Colorado has. So, and it's an election you can do, and it's a nice election you can do. So that's it. I'll move on from this, and then if anybody asks me questions, I'm happy to answer those. Next topic was something you could do with rollover Roths or traditional Roths. And a lot of people don't know this, and we had a bunch of questions on this year, is what's called a backdoor Roth. And a lot of people say, I'd like to put more money away, tax deferred, into a retirement plan. And how do you do it? If you've got one through work and you've made too much money and you can't do additional dollars, there's a legal way to do it. And they call it a backdoor IRA. And it's typically for high income earners. What in essence you're doing is you do a non-deductible IRA, you contribute dollars to a traditional IRA, and then right after 415, convert that traditional IRA to a Roth. And it gets around the limitation rules on traditional and Roth IRA. So it allows you to make the non-deductible contribution and then just convert it over to the Roth. And it's the conversion, because there's no income limitations on conversions, that do it. So there's some pitfalls in it. I won't go through those, but it's something to talk to your broker about. If you're interested in doing those types of things, is socking more dollars away into your retirement or a Roth account, this is some way you can do it. It's not a ton of dollars, but I do have clients that do it every year, and it's just a way to get more dollars into that Roth IRA. Okay. But again, something you can definitely talk about with your investment advisor or your CPA. Does it make sense to do this? And it kind of depends on your tax bracket, your current situation, your financials. Jump over to the next one. This is something I saw a bunch of times this year, probably 3 or 4. And I beg people, I implore people not to do quitclaim deeds on real estate. The reason it is typically, I'll give you the example. How do we move real estate from, an elderly generation or my parents or, an elderly person into the next generation? And a lot of people are attorney adverse, me being included in that. I don't like to spend money on attorneys if I don't have to, but this is what I would spend a little money with an attorney just to make sure you don't get caught in a nasty problem. And here's what it is. Basically, it's very easy to do a quitclaim deed, right? You can just go down to the courthouse. I think it costs $50, right? Fill out the quitclaim deed from dad to son, and you've transferred title to the property from dad to son. In the situation I had this year, dad was 83, he'd owned the property since the 90s, and I think he had quite a stack of real estate that was fully depreciated that were rentals. The problem is this: when he was about 83, they did it. Quitclaim deed is a gift. You're gifting property from the elderly generation to the son. The problem with that, it gets carryover basis, which means whatever the basis the dad had is transferred now over to the son. So easy example. If his only basis in that, because he bought it in the 90s, was $5,000, and the son says, I'd like to sell that property, he has a capital gain from, he sells it for $1 million, let's say. He has a capital gain of $995,000. Okay. The reason you don't want to do that is there's an easier or better way to do it, is to pass it through the estate. With a little estate tax planning, you get what's called a free step up in basis when property passes through the estate of a decedent. What does that mean? In my example, the $5,000 property would have been stepped up. The basis would now be $1 million. The son now sells it. He has zero gain. Okay. That's the nice part about it. So if you have elderly clients, elderly parents that are thinking about passing property, try to make sure you know exactly what's going to occur, what's going to happen. The difficulty with doing this of not passing it through the estate is that enormous amount of tax. And it's just because you've got gift or carryover basis. You get your dad's old basis in the property passed to you rather than that free step up, that magical step through or step up in basis on the estate. The reason some people do those quick claim deeds, they're afraid of dad goes into a nursing home and boy, you know, they're going to sell his properties and have to pay for the nursing home until he runs completely out of money. And they don't want that. It doesn't work. That strategy won't work is because most counties have what's called, or most states have what's called a clawback, and they can pull back the dollars that they try to pass out of their estate or their ownership for somewhere between 5 and 7 years, depending on the state, is typically the right amount. So to me, the best thing to do is really spend some time with either your CPA or an attorney and say, here's what we got. Dad's X number of years old. You know, we'd like to be able to transfer the property to the son. We want a good way to do it. The case I had, they did it in a quick claim deed, and I think we were lucky enough to get an attorney that went to court and said it was an error. It was really it really didn't mean to, but you can't always get that. And it was really lucky that the stars all lined up that we could overturn it, because it was $2 or $3 million worth of tax that we saved. But that's not always the case. And so be careful when you're transferring property, and especially if it's an elderly person that you're trying to move property because you're afraid of, they're afraid of, this is their estate planning tool, is really to move dollars from dad to son and quit claim deed it because they're worried about something happening when they're elderly or sick. Okay, and you can ask questions about that, obviously, of course. But I'll move to the next one. Really, we've got tax loss harvesting. Everybody's got losses, right? If we got stock market losses or even real estate lately, one of the things that we could do is what we do as CPAs is we spend a little bit of time with clients at this time of the year, especially if they have losses, of what can they marry up against that loss. Because if you think about tax returns, and on your personal taxes especially, you're limited to a $3,000 loss per year, right? And so if you have a $25,000 loss, a $100,000 loss, let's hypothetically say on real estate or even in stock market loss, we can marry that up with a gain. And the reason we want to do that is we can look through the brokerage accounts, look through my real estate portfolio, and possibly liquidate or sell something and to offset those losses, i.e. we then get no capital gain because those losses are netted together on your personal return. So it's a good time at the end of the year really to look through those portfolios that you have of investments, whether those are real estate or stocks. And if you've got some known losses, maybe it's a time to think about, hey, I've got some known gains that I want to marry together and offset them together. Okay, if that makes any sense, because the loss you have if it's securities is limited to 3,000. Real estate's a little different because you've got potentials of what they call passive activity losses that are a little bit different to deal with. But anyway, that's what I would do, is spend a little time kind of looking at what you have for losses, what you have for income or gains in real estate and offset those. Okay.
Hey, Dan, can I ask you a question? Can you offset a real estate gain with a stock market loss?
Typically, yes. Yeah, you can. And one of the nice things with real estate too is if it's passive, a lot of the let's hypothetically say it's not been a good portfolio and you've got real estate income that's carried or been accumulating over time, we can also offset your ordinary income with those accumulated losses and why they get released when you sell that property. But yeah, 1231 losses, which are what they call business losses or from real estate, can offset gains on real estate can offset losses in securities. So it's something to dive into and look at and see if you can marry those two things together and not carry that loss $3,000 a year into kingdom come. Okay. And that's something I would look at. And I do spend some time with almost all my clients in those areas, is really looking to marry up, some gains with those losses. And
what about like if you had an S corp or a partnership or something, and you had a gain in that was passed through to your personal return, can you offset that gain?
Yes. Yep, you can offset those gains with typically even with stock market losses. So that gain can be offset, but I definitely would plan it out carefully to really see how that comes through, and just make sure, because passive activity losses are cumulative, right? If I've got losses of other properties, those can get released too from like, for instance, what you said, an S corp or another partnership. I can offset a bunch of those as well. So look to see, right, especially on real estate losses, what else is going to get released, or excuse me, real estate gains. If there's any other losses that are get released with it, that you may pay no tax. You think you will, but you don't have any tax bill because there's a bunch of passive activity losses piled up. If that makes any sense. Hopefully it does.
Well, I can speak from experience because Dan's my CPA. My properties have been going up in value, and rental income has been going up as well. And I got hit with a pretty large tax bill this year. And what I should have done last year is actually bought another property,
Yep.
and just deal with a bunch of expenses with it to offset a lot of the gains. And so,
Yeah, I mean,
I
you can
did,
do it that way too.
yeah.
You know, the nice thing is, obviously, is if you got real estate, it's if you're materially participating, which is a little bit different than passive, but same thing. If I can create losses, right, is if I can do a cost segregation, right? If I got lots of gains that I go, oh my gosh, I don't have any losses, but can I do a cost seg? Absolutely. Right. So that's another way to offset a large gain with real estate, is go ahead and do a cost seg study, right? We can offset those gains with the losses from the cost segregation. So that's typically what I do with investors. We've got big gains. If we've got potential for cost segregations, that's a great time to do a cost seg, right? Is, if you talk to a cost segregation specialist, every day is a good day for a cost seg. But I say, well, not every day is a good day, but a good day is probably when you've got a bunch of big gains. So if I can bank up some of those cost segs, and then one day when we do have that big gain, I'm not forced into a like-kind exchange. I can probably go and do a cost seg or group, do 2 or 3 properties in cost segs, and then reduce that gain down to nothing simply by offsetting those gains with those losses. So those are something you can kind of do. Hopefully that makes sense.
And I'll just add that if anyone has questions, just feel free. I'll just stop Dan and pose the questions anybody has. So go ahead if you have any questions along the way.
Yeah, feel free. I hopefully I try to touch on it broadly, and then people will say, hey, I did this, and this. And my hope is always I can get your questions answered or point you in the right direction, or spend a little time just digging in for you and kind of see where you need to be. A lot of it isn't super difficult, but it is if you don't know and you're just a little worried about it. But let's bounce on to the next thing. Our next topic really. I just had some other stuff, right? What else is going on in 2024 or 2023? That's just stuff to be aware of. We've got net operating loss carrybacks and carry forwards. They've got rid of carrybacks, right? They opened it back up in during COVID, but I believe they're closed back out again. So we can only carry forward. So if you get a big loss, and they've limited the amount, so be careful of that, because I've had people say, I don't care to file my taxes because I got an NOL. I'm like, well, you only get a certain portion of the net operating loss, and you have to carry it forward. So they've kind of limited what happens on net operating loss carry forwards. The other big one, I've had a couple of these this year, is what inventory versus investment, right? Inventory property is what, right? If you're a realtor and you're buying and selling properties, or you're flipping properties, that's inventory. That's ordinary income. Okay. If you're renting properties, typically, right? Renting them to clients and holding them for a certain time, that's capital gain when you sell them. Okay. Where the problem is, it's no problem to do that, is when you get them intermingled, right? You've got some that you're flipping and some that you're renting. You don't really remember which is which. The IRS, if you wouldn't believe it, they tend to assume everything's going to be inventory or ordinary income property. So we'll be careful of that. If you've got that going on, there's some strategies you can use to really separate those two or build a wall between them. And so our investment properties kind of are hanging out in one spot, and our inventories are hanging out in the others. Okay. And then penalties, one of the big things that we've noticed, penalties, estimated penalties, failure to file, failure to pay penalties have really skyrocketed up. And that's because interest rates have skyrocketed up. the last year or two, right? We used to pay, up 1 or 2% in interest for these penalties, and nobody really cared because it was a couple of $100. But now there's real money. There's 5 and 6% interest on these, and so sometimes it's okay to take a look at these, and you can fix them, right? I've got that question in there. Can you fix them or get them waived? You can. Okay, so the IRS directive lately has been to waive them. And so a quick letter to the IRS, you can sometimes save a few thousand or sometimes tens of thousands merely by asking for the dollars and saying, hey, I want a one-time waiver is usually one they'll do, and they'll let you have it one time. Every 3 years is a one-time waiver, apparently. But they will waive those. So it's, a 20-minute letter can get you out of those penalties, and it's sometimes worth the money just to take a crack at it. What's proposed in 24 is, if you haven't heard about this yet, they won't be able to pass it if they got gridlock in the House and the Senate on passing it, but for tax purposes, like-kind exchanges, right? They want to limit those. They want to say that if you're single, you're limited to only a $500,000 tax deferred exchange. If you're married, a $1 million exchange. In essence, it's I don't think it's a good law. If they get it passed, it'll slow down the amount of transactions in real estate because it's pretty easy to have a $500,000 gain in real estate anymore, especially on a like-kind exchange. So really look at that and be aware that that's something they want to change, and that's not going away. They want to change it. The big thing they've tried to replace it with, if you ever get involved in, is low-income housing tax credits. If you want to build them or rehab, turn them into low-income housing properties, there's money there. The IRS, the feds, and the state will give you free money if you do that. And of course, this has been talked about since Hillary Clinton is closing the carried interest loophole. What are those, and what does that mean? If you ever own a partnership and you've had a profits interest, that's what they're talking about. They want to get rid of that and get rid of the ability to take it as capital gains and make it ordinary income. It's not a big deal. I don't think it'll ever get passed, but they always talk about it. And if you hadn't seen this, net investment income tax is what they call Obamacare tax, if you remember that. If you make a certain amount of dollars, you pay 3.8% additional tax, or the extra 0.9, I believe it is, if you make above 250. Okay, they want to bump that up to 5. In 2024, that's probably going to occur. And then they want to increase Medicare as well in 2024 by 1.2%. So, it's one of my themes. I tell everybody, where do you think tax rates are going? Do you think they're going down at all anytime soon? And they're probably not. And that's just because of the amount of money we spend as a nation. They're always looking for a new place that they can scoop cash. Okay, so be aware of that. I doubt if rates are going to go down anytime soon. They're definitely just shuffling them around of who gets what benefits and deductions. And that's all I had for today. So if you get questions, buzz me, call me, email me, or certainly feel free to ask here, and I'll try to point in the right direction. If you have an interesting question, feel free to buzz me or let me know.
Sure. So we have at least one question, right, Jay?
Yeah. What Sharina asks, do you recommend putting each rental property into its own LLC, or is an umbrella policy enough?
You mean it depends, right? That's more of a legal question of put your own LLCs into its own entity. And my response is always yes, and it's because it's the most conservative one, right? Is put each one in its own LLC. Why? Because when you put multiple things or multiple businesses into one, you marry the bad with the good, right? If we limit it to one entity, one investment in one LLC, it's in and of itself, it's its own thing. So it doesn't get married up to something else, right? A trip and fall in one property now is, if you've got it in two, you got two properties in one LLC, you now combine that problem into two. But typically, like she said, she was asking about a umbrella policy. You could probably get a pretty good insurance policy that will cover any of these. So, not to have to worry too much about having multiple different LLCs. And it really depends on the size or how big you're going to do this. And most attorneys recommend, I believe, is having, different LLCs for different properties. It really just limits it. And also, if you've got multiple investors, right? If you're out raising money, or you're in this in a partnership, makes it really difficult to add a new property into the existing LLC, especially if you're bringing new investors in. Okay, that mingling of funds and whose gain is attributable to what when you do that is always a problem for tax. And it's you're marrying the gains with something that has no gains. All that kind of stuff is in there. So I always recommend doing it on its own, but you certainly can.
Okay.
So that kind of creates or it can create sort of an accounting nightmare as well, right? If you have a
Yeah.
lot of different properties and they're all in a different LLC, do
Mhm.
you see people having sort of an umbrella LLC over the other LLCs?
Yeah, you can. I mean, that's one of the things that I've seen it done a lot too. Is you'll have you'll have the man, all kinds of different structures on that. I've seen it where there's a management entity, right, that manages and runs all the other LLCs. Like for instance, you can have it where there's 10 properties have their own LLC, but they're managed by the other LLC, a second LLC, or you'll have split it into two different groups, the A group and the B group. The B group's the management entity of each LLC, and the A group is the ownership entity. There's every different combination of that you can think of. And that's all I always say that's the an attorney's dream, right? Is to create these massively complicated structures, but it's you can kind of do it any way you want. That's the nice part with LLCs. There's not a lot of restriction to it, but it depends. Again, it's always dependent to me on size and what you're trying to accomplish. If it's trip and fall kind of things where I'm going to get sued, can you just own it each one individually? Yeah, and that makes sense. If it's really you've got multiple entities. One of the big ones we've seen is how do you do estate planning if you own entities and the management entity is run by one guy. If he drops over dead, the one guy that manages them all, we now have to send out operating agreements to every single one of the new entities to say, hey, this guy's no longer with us. We have to add these two other people that are now the new managers. The easy way to fix that is to create an entity that says it's got a board of directors, and if someone dies, it's okay. They just reelect a different board. And so it prevents the kind of legal madness of having to change all the operating agreements someone passes away or dies. But those are the reasons that make sense to do that is depending on what we're trying to do or how big this thing is. It's got 10 properties, it's got one. Really, what are we trying to accomplish in LLC structure? And how many do we need in order to accomplish it, right? Sometimes we can do it contractually, right? There's a contractual entity that manages. Sometimes it's an owner, all kinds of stuff like that.
Okay.
It just depends on what we try to solve, right? It's really what problem am I trying to solve? Okay.
All right, we have a few more here. At what real estate value does a cost seg make sense from a cost benefit standpoint?
What real estate value?
Yeah.
Cost segs are, to me, you're if you think about it overall, if I do a cost seg, I've changed really nothing about I've never changed anything intrinsically. In essence, I don't create any new deduction over, let's hypothetically say it's a rental property, 27 and a half years. I'm just moving when the deduction occurs, not how much. So it's always going to be the same amount. It's just when that deduction, occurs for tax purposes. To me, I think it depends on the cost seg group that's going to do your cost seg, right? That's what I always ask is what kind of fees are you going to charge to do the cost seg, and then find out, typically what that benefits you. So if you're going to spend $10,000, I'm hoping, right, it's not going to be a $1,500 benefit. So to me, I'd find out a cost seg if it's $5,000, $2,000. At least make sure that you get that much in tax benefit out of it before you jump into it. And how do I know? What's the big impetus for figuring it out? I used to use a rule of thumb of whenever I saw on a depreciation schedule land and then building, take 15% of the building, right? And that's about the dollars that are going to move into. It's a guesstimate, right? It's just my rough guesstimate of how many dollars are going to move into 5-year property that I'm going to fully depreciate that year or fix. I had people come up in a seminar before on cost seg saying, well, they didn't tell me that I got this huge tax deduction this year, but then my taxes went up the next year. And it's like, well, yes, because you just scooped out all of those benefits this year, and then you've lost them for the future years. So it's not changing the economics, it's just moving them to a different time period. That's why I say, I recommend people when they look at cost segs, make sure it's you've got a good reason to do it, right? I always like to bank them. I call it like a bank of savings, that if I do sell a property, I can now jump over and say, let's do a cost seg on these other four, and or three of them, and kind of figure out how much we need in cost segs to offset my gain, right? So I can get a huge gain offset by doing cost segs, but from one property, the gain, and then the other's the expense or the loss. The other thing to be aware of in cost segs too is if you're a passive investor, it doesn't do you any good, right? If I create some enormous loss and you're passive, I can't realize that on page one. So I've gone from, let's hypothetically say on a passive activity, you're just an investor in real estate, and you can't take those losses on page one of your return. I went from a $3,000 loss to a $300,000 loss. You've just built up a bigger bank of losses that are hanging out in your passive activity. So it didn't do you any good to do it if you're passive. Usually it's material participants, but if you're passive, the other way to do it is if I've got that big gain, right? And that's the way really to do it. I think, I'm always looking for that gain, and how do I get rid of it, and how do I save some money, and plan it out, right? Because I like to use my cost segs sparingly, because I want to use them only to the degree that I get rid of the gain and not create some other massive on top loss, unless I've got a compelling reason to do so, right? So when that brings up another question: when's a great time to do I've done this a couple times this year, is when do you roll over a traditional IRA to a Roth, right? And usually I'm looking for that in a planning opportunity. And that's one of my funnest ones to do, because it's really easy to do, and people think you're a genius, which I'm definitely not. But what I do is, let's hypothetically say, I had a couple of guys, they were oil and gas guys, started their own companies, and it was material business, right? In essence, they can take the losses on page one of their tax return. Well, he created $1 million loss, but he had $1 million in an IRA, a traditional IRA. So what we did is rolled his IRA over to a Roth, right? He's got tax on it. You got to pay tax on it when you roll it over, but it offset with the loss. So we paid no tax on the rollover because we married it with the losses from the oil and gas company. So he had almost a $0 tax bill, and now he has a IRA with no tax consequence when he takes it out of Roth. So he thought we were geniuses. I didn't want him to think anything else, and so we just left it at that. But but those are the kinds of planning opportunities we're looking for. Is those big items that come up of big losses, and is there a way we can scoop something out in a big gain and get rid of all of those tax consequences in the right year, right? Those perfect set of facts, or we're looking for those opportunities where, hey, I've got properties I can cost seg, and I created this big gain, and can I marry those together to make no tax bill at all? And that's what I'm looking for. Those are the big times that people love us. Most of the time they don't, because I'm like, for Jay, I got to call him and tell me, oh, tax, which I don't like doing. I don't like calling anybody tell me, oh, tax. But those are the times when we really enjoy calling people. It's like, hey, we got $1 million out of your IRA tax free, and they don't really know what you did, but they just think this is some kind of miracle. But it really isn't. It's just really looking for the right opportunity, and with numbers with commas in them, and you have good opportunity. That's where people like us.
Hey, Dan, we got a few more minutes. We got two more
Yep.
questions.
Go ahead.
Right. Next one is, how can a car purchase offset tax liabilities? Is personal or business better? And
Say that again.
How can a car purchase offset tax liabilities? And is a personal or business better? What are the parameters for car purchase in the business?
So, automobile, cars, yeah. So the hardest thing you have always is, in 2018, what happened is they got rid of miscellaneous itemized deductions, right? So if I'm a W-2 earner, I can't create expense from my automobile anymore if I use it for business. So if I'm a salesperson, I can't, the hope is I get reimbursed from my employer for my automobile because there's no deduction for W-2. So typically you want to run your automobiles through your business, right? Your biggest is you get Section 179 on automobile for your usage of that car. So if you use it 50% or more, or excuse me, more than 50%, sorry, you can take Section 179. So the big ones are it's always in the tax code. If you look this up on the Google, you'll see it. It's called Section 179 or bonus depreciation. And you can see those limits, right, on what they call SUVs. So you're looking for a vehicle that has a gross vehicle weight of greater than 6,000 pounds. And those create massive deduction, right? The only downside is it's depreciation, right? You're going to depreciate the car faster. So if you get rid of it next year, you got to add it back. But yeah, you can create that on your entity by getting bonus depreciation or Section 179 for a big heavy auto. And I will tell you, one of the most confusing things that's recently come out is all the electric vehicle stuff, right? There is some big credits in electric vehicles if you want to go that way, but the morass of state and federal law on electrics is amazing. So you want to know before you buy an electric car what those credits are, because you can buy those personally as well. And for instance, if anybody bought a Tesla, those credits were huge, right, for federal and state. So those are still out there, and I don't know if they're still for Teslas, but there's all the other knockoffs, the Rions and the Leafs and the Toyota stuff and the Fords that are now coming out with electrics. And I think they're still there, but you always have to be pretty careful. You got to look. There's a website I can send you if you email me, and it'll lay out. It's kind of it's a federal government site that kind of lays out all these credits that are available on electric vehicles, and those are okay not only for business but also for personal, right? So look at those. But for gasoline, your big one is still buy the most enormous vehicle, the land yacht you can find, and make sure you use it more than 51% for business, and you can create an enormous deduction on your tax return for it because you take the 179 deduction on it. Okay. What's the next question?
Garland asks, how much tax would be expected on a sale of a capital gain of $1 million? Property is fully depreciated.
Let's hypothetically, if you sell a property, remember there's two things in real estate that occur, right? Is here's what I would do. There's really three layers of tax in real estate. Number one is what's called depreciation recapture. Depreciation recapture means I've already depreciated something, and now in essence I've taken an ordinary loss for it for all these years, right? Let's say he's got a rental for 27 and a half years he's owned. So the IRS says, oh, you sold it, let's say purchase it for 100,000, sells it for $1 million. You've got, first and foremost, you've got to add back 100,000 of depreciation. The IRS gives you a break. They call it you get 25% what they call depreciation recapture. So the first and foremost thing, if you got a gain, is that 25% depreciation recapture on the real estate. Then anything above and beyond that recapture is then capital gains tax rates, which would probably be, you're looking at federal and state, let's shoot for, 20-24%, somewhere in that neighborhood, right? Of federal and state, depending on the state you live in. For Colorado, you probably look at 24% gain plus the 25 or 20, depending on your tax bracket. Does that make sense? In essence, you're looking at your capital gains tax rate plus your depreciation recapture would probably be about your gain. That would be it.
Okay. Thanks for answering that. Final one here, which you'll appreciate. Monet asks, are you taking on any new clients?
Always taking on new clients. The hardest thing in CPA world is 30% of all CPAs quit in the COVID because they said that it's too much work and said, the heck with it, I'm going into banking. Or something else. I don't know, but we're still here. The challenge really is for us is it's always being creative in hiring, right? Is our trick is, we're constantly looking for talent, and the way we've set ourselves up as a business is we've tried very hard to be dynamic. We can hire, I've got a friend in Buffalo that I'm probably going to hire, right? She used to work for me years ago and she's looking for some work, and we're set up. So that's really easy to do, right? We've got a really secure system that's all in the cloud, and she just has to have a high-speed internet access and a username, password, and a cell phone, and she can get in and log in. But that's what we're always taking on new clients, and our hate to pitch myself, but our big thing is always doing a lot of planning, right? We love to do it, and it's those complicated situations we really like, where we really think that that's the value add, is right. We can help save some money. I would tell you on that real estate sale, one of the things to look for is if you got personal property in there. I forgot to mention that is, if you think about one of the big things I see in a lot of sales on real estate is people will assign gain to things like, they'll have an asset list and there'll be dishwashers and carpet and the odds of you having a gain on a used dishwasher as an economic reality is about zero, right? So probably the best way to deal with that, you could probably push some of those, you want to push your proceeds into the land and building, right? Rather than into the dishwashers, the redoing the floors, the refrigerator. Those kind of things are probably fully depreciated. Nobody buys real estate, right, for an old used dishwasher. So try to look at that, and you could probably scoop up some ordinary loss with that to offset that gain. So it's a way to save a little bit of money, is really look at that. Don't just group all of your sale together, because you'll be selling dishwashers and fridges and washer and dryers for 5 times what you bought them for, which is an economic non-reality. So look at those whenever you do a sale, is that personal property probably has no gain. Okay.
Okay, thanks, Dan. That's it for the questions.
All right. Anything else you can think of?
Not right now. I think we're good, but I really appreciate you joining us, Dan. Thanks again. Very informative.
Perfect.
If anybody wants to get a hold of Dan for any additional questions, here's his information here. So look forward to doing this again in the future, Dan. Thanks.
Okay.
Thanks.
Yeah. Any questions, feel free, buzz me. Absolutely.
All right. Thanks, guys. Take care.
All right, guys. Take care.